I'm going to share with you how to manage your capital and also grow your account using, the low risk method and technique. Okay, the low risk method and technique. So, when it comes to trading, we all know that there's a risk applied to it. Just like, forex trading, boom and crash indices and other type of trading as well. There's always a risk, to it. Now, when it comes to, this boom and crash, trading, there's a high, risk in the market. Okay. So now, what are the risks in this type of market? The risk is that if you enter into the market without knowing, how the market works, that's a high risk because you might end up, losing or blowing up your account. And also, if you enter into the market without, doing a proper analysis, you will end up with a losing trade as well. If you enter into the market without using, a good strategy that you know how to use, you will end up blowing up your account as well. Okay. And if you enter into the market, then you just follow what you see. Maybe if the market is buying, you just, place a buy just to follow, the market trend, just like that. You may end up, blowing up your account as well. All right. So now you have a smaller account, or you want to manage, your capital so that you can, raise it higher or grow your account without, losing much on the trade and using, this low risk, management, technique. All right. What you first of all do in this market, the thing you first of all do, all right, I want you to jot this down. First, when you enter into the market, you look at the capital that you have. For example, you have $50 in your account and you want to use that $50 to trade. What you should do, is to plan how much, you are willing to raise this $50 to. Let's say you want to raise this $50 to $200, right? You want to raise it to $200. Now, what you do is to, calculate, how many candlesticks you want to be taking in a period of time. All right, in a certain amount of time, how many candlesticks you want to be, collecting, and how many spikes you want to be cashing in the market. Then the next thing is to set the lot size. Here, this is the lot size. You set the lot size. All right, when you set the lot size, this lot size now is, let's say you have the $50 account right now and you set a lot size of 0.2 now. 0.2 now will give you 10 cents from one candle tick, one successful candle tick. So what you do now is to calculate how many candle ticks you are willing to take for each trade entry. Okay, how many candle ticks you are willing to trade. So now you are using this $50 now to place a trade with a small account with a small lot size of 0.2. And for each successful candle ticks that grow into the market, each successful candle ticks right here, which is this one, let me zoom in clearly, this one here, will give you 10 cents. Okay, we give you up to 10 cents from this market. Another one will give you 10 cents from this market as well. All right, using a lot size of 0.2. Okay, so 2 successful will give you about 20 cents, right? 20 cents from the market. 3 will give you 30. All right, 4, 40 cents, 5, 50 cents. Then 10 would give you about $1 from this market. 10 successful candle tick. So you now say from every 10 candle ticks you've gotten successfully in the market, you get $1 as profit. Okay, remember you are putting your $50 inside, but there's a risk. If this market right now crash, right? Because if you buy the market, you cannot set stop loss because the stop loss will not work. So if the market crash now, you will end up losing your trade. So your account will be counting minus. So that your $50 might end up going up to $30 in a short period of time if you don't know what you are doing on the market. Okay, if you don't know what you are doing. So before you enter the trade, before you place your entries, always calculate the amount of lot size you are going to use. That should help you minimize the risk on the market. Okay, you calculate the amount of lot size you are going to use. Then you set the amount you are willing to risk. If you are willing to put in $50 in this market, then you put it after you have calculated the lot size and how much profit you will get from that that's capital you are willing to risk in the market. So when you have set the lot size, then you start, placing your trade after you have, seen a better entry position. All right. You have seen a better entry position using, a good analysis. For example, now this is 5 candlesticks right here. Okay, 5 candlesticks will give you about 50 cents from the market. So if you stayed on this type of market right now without doing a proper analysis and the market crashed, you will end up on a losing trade. So what you should do right here is to look at the market condition first. After you have calculated your lot size, and you have set the amount you want to put on the market, you will now look at this market condition. Many beginner traders don't do this. They don't do this. What you first of all do is to first of all relax, clear your mind, then look at the market condition, how the market is doing. All right. So we see that the market sold here. Take a look. It's sold up to this point. Then take a look right here. It bought up to this point here. Then what will happen next? It will sell again, go to the downward side. It sold here. It bought again. It sold just like that. Buying and selling, buying and selling. And in this type of buying and selling, the market will continue to go in the direction it's supposed to go, but because it is called the crash market, the market will continue to crash, go up again, it will crash just like that. Now take a look. This market from here now, it bought up to this point here. The market just spiked. We witness it. Okay, look at it. Zoom in a little bit, you'll see this market just spiked. Now from this point, it dropped up to this point. This market will see spike again because the market has gotten to the overbought. So the next step is that this market will now go to the oversold, all right, before it will retest. But this doesn't mean that the market will not buy again. The market may buy up to 4 candlesticks, 5 candlesticks before it will drop again in price movement. All right. But what most traders do not know is that during this point in this type of market, it is not, good for you to place a buy because there's higher volatility at that point. The market is at the overbought. The market wants to drop in price movement. So you just witnessed a spike. So you do not place a buy during this point in this market. So people that are not patient, traders that are not patient, we enter into this market like this without doing proper analysis. If we go to the 1 hour time frame right now, 1 hour time frame, we see that this market sold up to this point. The market has bought up to this point. Okay, you see, it started to buy from here to buy, and we know that on the 1 hour time frame, it takes hours, 1 hour for one candle to go up a little bit. It takes another hour again for another candle to go up a little bit, and you can see that this market have gotten to this point, and it took hours for it to reach here. It took hours, right? So this market will drop in price movements. You can see that this market, it bought to this point here before it retested down to this point, just as it did on the 1 minute time frame. So this market need to show a red signal, which is a drop in price movement. It will not drop before it will buy again. So if you want to scalp this market, you should be looking for a sell entry. All right, you should be looking for a sell entry. If you place a sell at this point of this market, the market will sell because it's at the overbought and there's a higher volatility and higher chance for the market to drop in price movement. So, these are the ways, you can minimize, the risk on the market. You can, grow your capital. You can, guide your capital and also use this, low risk management technique to help you grow your small $50 account into a big account. All right. I hope you understand what I'm saying. Before you enter into this market, before you start any of your trading, always, plan your strategy. When you have planned the strategy you are going to use, first, after you have planned the strategy, you now bring in the capital which you want to use to trade for that day. Your capital now is $50. How much do you want to make in advance of this $50? What is the profit you are going to make at the end of the day? Let's say you put on $200 now. $200. You want to turn $50 into $200. So now every five candle tick you take will give you about 0 point, it will give you about 50 cents on the market. Okay. Then if you take about 10, will give you about $1. So these are just estimates, but it should, right? It should. So you take 10 candle tick is $1 for every successful 10 candle ticks you take. We give you 10, we give you $1 for every successful candle tick you take. We give you $1 from this market. Remember that you have 24 hours in a day. So if you put in that $50, you successfully gotten 10 candle ticks from each successful entry. That's $1. You get another one, that's $1. Before you know it, that $50 you have will turn into $200 in no time, as long as you know what you are doing. All right. When I'm trading, I always use the 1 minute and the 1 hour time frame to confirm most of my entries. All right. I also use the 30-minute time frame, but I don't use it that much because the 1 hour time frame always give me a successful entry position. It always give me a good signal. That 1 hour time frame, the 1 hour time frame is the golden time frame that will give you that signal for you to scalp the market on the 1 minute time frame. I hope you understand what I'm saying. It will give you that signal. The 1 hour time frame always give you the signal for you to take your profit on the 1 minute time frame. Right here. All right. Now, what I'm going to do right here is to test a simple strategy. This simple strategy will help you with low risk management. It's a low risk management technique. All right. Now we'll go to the indicator section. We'll put on the moving average. Just as you can see here, these are the setup and the parameters for the moving average. The main reason I added the moving average is for you to know that this market is, look at it here. If you trace it downwards to this point, you can see this market is about to curve, going to the downward trend. This is the moving average, guys. It went upwards and it's giving you a signal that it's going to curve downwards, meaning that the market will soon spike, just as it did here. It retested, it sold, right? You see. So this moving average right now is giving us that, all right, this market is going to the downward trend because it has gotten to the overbought. Now I'm going to put in the RSI indicator. Okay, the RSI indicator, very powerful indicator for you to use to trade. These are the parameters as well. All right, then we're going to put on the MACD indicator. These are the parameters. Now these three indicators right here is one of the best indicators that I use to trade, and they are very successful if you use it to trade and if you know how to use them very well. Look, if you know how to use the RSI, the MACD, the moving average, and you understand price action, there's no way you will have a losing trade. There's no way. Although there may be a losing trade, that losing trade, maybe you want to cash spike and the market, the spike didn't come in time. Remember that your account is going to be in the minus. So what I mean is that you are going to count more of your profits than your losses if you know how to use these three indicators successfully. All right, these three indicators are very powerful. Now, when you're trading this crash market, I always tell most of my students that they should always understand that this market is not friendly at all. This market is not friendly. This market want to always crash all the time. This market want to go downwards all the time. It can trick you that it's going to buy, but before you know it, it's going to sell immediately. So that's why you should know when the market is in a position whereby there's higher volatility. Most traders, mostly beginner traders, do not understand the word volatility. They do not understand that. All right. So these are what you should know. When price is at a position whereby there's higher volatility, like a position like this now, there's higher volatility during this point. So you want to avoid buying the market at that very point those region, this overbought region here, you want to avoid buying the market during this point because the pressure of which the market will use to crash is very high. It's just like you throwing a stone upwards. The force you use to throw the stone upwards is not the same force the stone will use to come down. In short, the stone will use about times 2 of that speed it used to go upwards, times 2 of that speed. That's what it will use to go downwards. All right. So you want to avoid these things, and these are things you should also know for you to have a low risk trading on the market. I hope you understand what I'm saying, guys. I hope you understand. So using the RSI, the moving average, and the MACD together with price action strategy, and you understand that this market will always crash all the time, and you understand that there's a higher volatility on this market, you should always have a successful trade. There is no way this market will beat you. You should always, beat this market. Now, take a look. The MACD has gotten to the level of 90. The spike came into the market here. The MACD went downwards, but it didn't. When it started going downwards, it didn't retrace. It didn't show below like this side here. Instead, it went upwards again and it spiked. And we are seeing the same scenario again. At this point, it will go upward now like this, and it will spike again. Do you understand, guys? Take a look at this point. What I'm showing you here, let me zoom in a little bit so that you understand this MACD very well. Here, the MACD from here, it touched to this level of 90 and the market spiked, right? It went downwards. Instead of it to started going a downward trend, it curved upward. Immediately it curved, just know that there's another spike on the way. It curved upward like this. Take a look. It spiked. All right. And instead of it now to go downwards, like this point here, instead of it to go downward, normally, if the market gets to the level of 10, the level of 90, it will now go downward, start creating a downward trend to the level of 10. But if it, retraced, giving you that U shape again, know that there's spike coming. So this is a signal. This is a signal. It's now informing you that there's spike coming. So these are what you should know. All right. A lot of traders will not agree with this because they don't even know how to use this MACD to trade. And remember that it does not matter how you trade as long as you are winning. As long as you know what you are doing. It doesn't matter if you are taking 5 candlesticks. It doesn't matter if you are trading to be successful. It doesn't matter if you are trading. It doesn't matter if you are scared on this market. Because you should be scared on the trading market because this market is not friendly. It's not a play business. It's not a game. It's business. You put in that capital. You should know what you want to do with it. And when you are trading in this type of market, you do not take your eyes off the screen. Because the next step might be a spike. And that spike could take all your profits and even end up blowing up your account. I've been there countless times. I've blown my account countless times before learning all this that I'm sharing with you guys right now. So I hope you understand this strategy that I've shared with you. All right. I hope you understand this low risk strategy technique. Remember that this market is not your friend. It wants to crash on you all the time. So always analyze this market properly. Always go to the 1 hour time frame to confirm your entries. Then use a good strategy. Use a good indicator that you understand perfectly. And always practice. Without practice, you will not understand this crash market. If you are not practicing the market all the time, you cannot understand it. You cannot. If you check most of my videos, there's a time whereby I predict this market. I will say that this spike is coming right now. And before you know, the spike will happen. The reason I'm able to know these things is because I've been, consistently trading this type of market all the time. So I know how this market works. And you can also know as well, if you trade this market consistently every day, if you don't have, capital to trade, just go to your demo account, keep practicing this market, and you will be so familiar on the markets and you know how it works and how to counter it and how to use it in your favor. All right. So I hope you understand this video that I've shared with you. If you found value, do well to like and subscribe, and also join our Telegram community, the Daily Forex. The link is going to be in our description down below. I'll see you guys on the next video.